All right. Good morning, everybody. So it's jobs data really that's on the table for today. We have JOLTS. If you're unfamiliar with that term, basically think of it as the take this job and shove it data. If there's a lot of jobs out there, then the grass looks greener on the other side, and people are willing to leave the job they have to go find that greener grass. But when jobs are scarce and you really don't think that you would find another job if you left the one that you have, you tend to hang on to the one that you have. And that's what this data reflects. Um, a lot of jobs or a lack of jobs, and people's willingness to quit the job that they have to go looking for another job. So it's called JOLTS, job openings, but to easily remember what it is, I always just think of it as the take this job and shove it data. Other than that, we have additional auctions today. If you didn't catch what was going on yet, it's FOMC week. So we're still anticipating a range bound market into Wednesday and into Wednesday afternoon before we finally get that data. It is worth pointing out that I don't want to say we know 100% what the data is going to be, but it seems that the market is pretty confident about what the numbers are going to be. The Fed has done a really good job of communicating this rate hike. So we're at a 96.2% chance that it's going to be a 25 basis point rate hike. Because of this, there's not really as large of an unknown. Now, that doesn't mean that there won't be any kind of volatility because there's still things that we don't know yet. Are they going to announce a pivot? Are they going to announce a pause? When will that be? Will they set any criteria with it? Are they going to say we need to see this kind of benchmark before we do blah blah blah? So there are still some unknowns that could cause some volatility, and the current expectation over the last month was sell, buy the rumor of a Fed pause, sell the news of a Fed pause. The second half of that is coming into focus. If they do announce a Fed pause, it's very likely we're going to get a negative market. So just something to really kind of keep in mind, right? As much as it feels like the market is done with the lows and we're headed back up again, it won't be a straight shot, and we could see some downside movement here, right? Even 3,800 isn't off the table, and I'm not talking about by the end of the week, right? Just bigger picture. So, kind of keep your focus. So we had an ECB speaker. We're going to get a German finance minister speaking. Then we have factory orders and jobs data. And that's going to be about it, other than the additional auctions. We have Asian markets closed, China and Japan. So their lack of participation, we should be able to see that when we get to the volume structure. Here's the SPX and the ES spot gamma levels. And here are the NASDAQ levels. SPY. And the QQQ. So you can grab your screenshot, mark your levels out for the day. So as you can see, we got additional auctions at 11 a.m. And after that, we're good to go. It is the front end, so you could use something like IRX and kind of get an idea of the expectation. I meant to hit that founder's note real quick. We had a positive gamma structure yesterday, and when we have a positive gamma structure, we want to buy the dips and sell the rips. It's an expectation of a range-bound market. We don't want to buy strength and sell weakness. And we can normally see that in the founders' notes. Now, I don't get their email where they really lay out what's going on with the gamma structure. That would be beneficial, but I don't have it. It's okay though, because we can still look at the gamma notional levels, and we can look, at gamma tilt and the gamma levels, and just see if we're looking at a positive number or a negative number. So the positive numbers, the expectation is going to be buy the dip and sell the rip. Don't buy into strength and sell into weakness. Now, it's not as high as it could be, so it's pretty low on the grand scheme of things. I think it tops out at 5, maybe 6, and we're at 1. So, it's slightly positive, not overly positive. There you go. All right, so we did make it through yesterday without hitting that daily pivot. So that is an MDP that actually managed to go all day. We've already hit today's floor pivot, so we don't have an MDP today. We had a pretty narrow IB, and that sustained us for about half the night. But then we got into the kill zone, seen some of that volatility, and we've retested the lows. There's still liquidity there. So, should we retest again? We want to see how much more of this we can absorb from down here before we finally are able to make it through or not, or if it's going to hold and finally be enough to perhaps bring us back up and retest the Globex high. Let's do that. All right, so what I did there is just move that yellow line to yesterday's low, because sometimes when you're dealing with the Globex and you're dealing with this time frame between 4 p.m. and 6 p.m., you get these candles through here, and it's already shaded on Thinkorswim, but that doesn't necessarily mean that it's going to be, quote, the low, right? So what I did is I came back out to the daily chart, zoomed in to yesterday's low, and moved the line down to that level. So, when we're looking at the close, that's one thing. But when we're trying to find the low of yesterday, where does yesterday end? Not at midnight, right? It ends wherever the broker says it ends. So if I had not done that, we would think that the low of yesterday was up here. So two different things. I did mention the volume this morning being a little light. We can see that at 75. But we have a pretty clear idea of why it's light. So it's not a big deal. No problem there. We just go ahead and remove it, get it out of the way. So I got a line here across the top. $42.08.5. It's going to be the line in the sand for us. Now that line by itself is just one single tiny data point. It's more about this zone or range that we're in up there, right? So if we were to mark it out, 4180 to 4208.5. We need to get out of this zone one way or the other. Now, a little bit of that's going to have to be FOMC this week, but FOMC is not the only data point. There's a lot of data points for this week. Thursday and Friday have their own issues. Thursday is Apple reporting, and then we have Friday's data. So it's going to be jobs data mostly that we want to focus on. But this entire week combined is going to be what we have to resolve with this high here. I was listening to a couple of different CMT specialists that were talking about if we could break this level, we could get into 43, 43.5. So something to think about. Kind of, I know options on futures isn't very glamorous, and if you're unfamiliar to options, then the options on the futures is even more complicated. But they're really not complicated once you just like anything else, kind of get used to it. And I bring it up because when it comes to selling out of the money options, selling options on the ES or on the MES, if you're using a smaller account, uses less buying power than trying to sell a naked option like SPY or a naked option like the SPX. So you can actually sell naked options on the MES in an account with less than $5,000 in it. Now, if you're thinking, well, that don't sound like a small account, it is if we're on the sell side. And if you wanted to try to sell a SPY option, you need, $40,000, or an SPX option where you need like what, $100,000. Goodness knows, it's an insane amount just to be able to sell, a naked put or a naked call. So when I use the words only 5,000, 5,000 small compared to those numbers. So here, just for a demonstration, if I wanted to sell this SPX option with a margin account, not using margin, but just having the privilege of being able to use margin, I would still need $411,000 per option that I want to sell. So, $5,000 buying power. Why does that matter? Well, with the ES, you can go pretty far out of the money, and I mean pretty far out of the money, and still be able to sell options for a reasonable amount of money. When you take that and you bring it back to something like the ES chart and consider selling an option at, I don't know, 48 or 47, you really think we're going to go back to all-time highs in the next month? Nah, me neither. What about the lows of last year? You think we're going to revisit those in the next month? Nah, me neither. So, you can sell options at, I don't know, 35 and 47. I don't want to say that they're, guaranteed or that there isn't any risk, but since they're naked, they are defendable. So it's not so hard to imagine defending them. And it's just maybe putting money to work that you're not using right now while you're waiting for, something better to come along. Now, I went out to 3,400. I'm pretty far out there. And the profit on that is $1,000. It says 108 days, but we wouldn't hold it all the way to expiration, and we wouldn't aim for the full $1,000. Now, that's a naked put. You could do put spread, whatever. Kind of just play around with this. The idea, though, is that's an option, right? There's an opportunity here to maybe put some capital to work that you're not using because of FOMC or because of the uncertainty, because of this run up where we haven't topped out and started to fall yet, but we haven't broken out and started to run yet. And we really don't have a solid play until either one of those happens. So if you're in wait and see mode anyways, you're not using the capital, why not put the capital to work for, a little profit? I just showed a 3,400 put, which means we would be selling a put lower than this low from last year, going that far out of the money when you wouldn't even really need to. If you got any comfort at all with your ability to read price, you could sell, say, 78.5, or maybe I said 78, I meant 37.85, or even 38.50 if you wanted to tighten it up a little bit. That would almost triple the amount of credit you get, very likely. For today, we have a 1% ADR. So it's same as where it was yesterday. The ADR half goes from 42.01 to 41.57. The full ADR from 42.22 down to 41.36. So not quite 100 points. 80 something, 85 maybe. So we could reach these levels, but because of FOMC on the horizon, it's not likely that we're going to reach those levels. What is more likely is if we begin to do anything at all, we just tag the edges of the ADR. We do what this says. If you was watching when I went through the spot gamma levels, they're calling for 0.87 for the 1 day implied move. We've got 104. They've got 0.87. Right now, we've only moved 0.2%. So, for the entire day, there's still plenty of room left. Plus half the day is done already. I know it might not feel that way if you just woke up, but if you consider the 22-hour trading period we have to work with, starting at 6 o'clock last night, we're past 6 o'clock now. So we're more than 12 hours into the trading session. The day is more than half done already. We are working with a very narrow range. That makes it easier to identify some levels. So we'll just go ahead and get rid of this stuff for a moment. Use your quant tool down here, quadrant lines. Just mark the Globex low and the Globex high. Do the same thing in reverse. Now you've got your high lows based on just the Globex. And if you wanted to take it one step farther, you could do the same thing with yesterday's high and our own Globex low this morning. Although I see I'm not really on the low because there is a low over here. Let's use that one. All right. Now what you're going to notice when I did the bigger one, when I did yesterday's range instead of our own Globex range, is that a lot of these levels lined up with each other. Nearly perfect, really close in, and just a little wider as we got farther out. So we don't need both. There's no reason to stress over, well, which one should I do? Just pick one. It won't matter. They're close enough together that it won't matter. The difference, however, is where the front end comes in. So let's just, since that we can see that they overlap, we don't need to worry about yesterday's. We'll just zoom in a little bit on today's. There is what I call the warning level, the 111 area. That comes in really handy for double bottoms and double tops. The idea behind it, with a double bottom being a bear trap, is that when we break through the bottom, we don't know if it's actually a double bottom and it's trapping bears and then it's going to rip to the upside, or if it's really breaking the bottom and we're going to go down. So one of the things that I like to do when I'm trying to decipher that is pay attention to the 111, the warning area, and the 1, 2, 3, 6, which is just one of the regular fib levels that I use. I took my quant tool and I stuffed some fib levels in there, like stuffing a turkey. So with that in mind, if we get that double bottom, even this little micro double bottom here, and we start to, really expand below this last low, trying to identify if it's a bear trap or not, I'll watch these levels. If we don't actually get all the way down to the 111 and we start to rebound back up, I'm a little more confident that we're going to roll over and go back down. If we tangle up into the 111 and reject off of it soundly, then it's much more likely that it was a bear trap and we're going to rip to the upside. If we go cleanly through it and get to the 1, 2, 3, 6, then that's a breakdown that's going to begin working through the fib levels. And I'd expect something like a Busby and, a play to the downside. Same thing works on the other side if you flip over everything and just do the same thing across the top. Our expectation is not an expansion today, right? We're waiting on data. We're waiting on FOMC. So there's not really a whole lot of expectation for markets to move around all that much, especially after that 2-day run, right? Last week. So with that in mind, I've got that red zone all marked out. It's very unlikely we don't pass through that zone today, which means we want to focus on Friday's levels 100%. Put all of our attention and all of our effort into Friday's levels. Between Friday and yesterday, we should have more than enough pivots to deal with whatever kind of comes our way, right? I think we got more than enough. 10-day, 30-minute volume profile. When we're at the low, we expect to go to the high. When we're at the high, we expect to go to the low. Point of control is below us, and we've got a minor price shelf at around 41.75, 41.80. If we break that, we're very likely going to go to the point of control fast, which would be 41.50. Notice how we went from the point of control up here. We moved through this zone, this shallow area here, relatively quickly. That gives us a minor air pocket. So if we break yesterday's low, we should fall back through that zone again, just as fast as we went through it to the upside. I'm sure you've all heard at some point the markets go down faster than they go up. Well, we went up through there really fast. We could assume that we'll come back down through it the same way. If we don't find structure at 41.50, we do get into a bigger air pocket where we also moved through before really fast, and that we're likely to move back through again really fast. But we are talking about getting through the point of control. It's going to have a lot of structure. Market very likely will respond there, get tangled up, not continue in a straight shot. And I'm going to point out something that we have talked about before on the morning briefing, that there's something down here that the market keeps hitting, but it's not this market that's hitting it. There's an inverse market or a correlated market somewhere, and that other market is hitting something, and then the ES is responding when that market moves. We noticed that before when we were looking at this air pocket, and we had areas, or we had these recoveries where it should not have recovered. It was like it hit something and it bounced back up, that there was some structure or some support. And we know, looking at the volume, that whatever was holding this up, it wasn't coming from inside the ES, right? It was coming from somewhere else. So if we do break point of control, we really want to pay attention to that 41.32 cog line. And, just recognize that it could get a helping hand and actually hold there, even though we don't see anything here. And there goes the ES, 41.77. Where are you going? Back down, check the Globex, I guess. All right, so the point of control, or the version point of control, is no longer valid. And the one from yesterday got hit during the kill zone move, so we don't need that either. We do have one at 42.30, and we still have the 40.43, but neither one of those should come into play today. Very likely not until after FOMC. Here on the 5-day, 5-minute, with this volume profile really wrapping up price nice and neat, I think it highlights how compressed we are and how compressed we were yesterday. It might have felt like we were really rocking and rolling and moving around, but really, we didn't do much yesterday. Now, take a good look at yesterday and think about every single day in the ES having that kind of move. From 41.80 to 42.05, 25-point move in the whole of the day. I mention that because pre-COVID, those were the kind of days we would get a lot. We weren't hitting even 1% moves, and the average daily range was closer to 0.5%, and often 0.75%, not 1% and greater. So you're going to have to try to figure out how to make money on a day-to-day basis when the ES is moving while you're awake, maybe 10, 12 points in that RTH session. It's a different kind of trading for sure. We are 0.5% above the 10-day, managed to complete the curve cycle here, the wave, but we are already on the way back down again. We didn't get much out of it, right? The waves are really small right now. And FOMC is going to take precedence over everything else soon enough. If you're thinking about options, keep in mind that after FOMC comes out, they're going to crush the volatility out of those things even more. There's a lot of good write-ups on what that looks like. And Spot Gamma and others have posted old FOMCs, right? If you go back to previous FOMCs, go to Twitter and look at Spot Gamma's posts on their explanation or their anticipation of what volatility was going to do after FOMC announcement. Now we're going to still have Apple, and then we have jobs data Friday. So it's not like we're going to lose all of our volatility, but we're going to lose a large chunk of it. Speaking of volatility, we have seen some pretty good lows. The idea is eventually we're going to see a VIX with a normalized number of around 11 or 12, but that's eventually and not anytime soon. It's cheap right now to think about getting some insurance, but if you're just looking for a trade, like, oh, maybe I got some capital available, I'm gonna go trade the VIX because it's low and there's an expectation that it might pop. That's not a really good play right now. The VIX is a dud, and it's gonna take this extraordinary event to really move this thing. So we could get into the 30s or, maybe even get into the 40s, but it would take something very drastic, very extreme. Otherwise, we're very likely not going to get that. And if we don't get that and you didn't buy an at the money VIX call, then you're not really going to get much. So trying to go out of the money, buying a 30 or a 35 VIX, you're just throwing your money away. Unless you need the insurance, right? So if you've got a portfolio, you got a bunch of trades on and you want to protect it, and you want to hedge a little bit, then now's a good time to do that because it's so cheap. Just like insurance, you might not like it to pay, homeowners insurance, but you're going to be grateful for it if your house burns down. So with the VIX, if you got a reason to do it, right now is a really good time to do it. But if you don't, there's really no reason to come in and screw around with it. There's much better things to trade with the expectation of, volatility coming into FOMC than using this. So that 101 on the dollar seems to have held. We talked about that last week. And we're now looking for the top side of this zone or range. It's kind of the idea that we're looking for the sweet spot, right? We don't want it to crash and burn below 100, but we really don't want it ripping back above 105. That's a pretty wide structure that I just gave there, $5 between 100 and 105. If you want to tighten that up a little bit, 101 on the bottom and a 103 on the top. It needs to just kind of hold itself within that zone without getting too wild within it, right? And by wild, you can see the kind of days that we've had. They're pretty good size swings. Now they didn't have much follow through. One was a deep move to the downside. The other one was a sharp move back up, but we're still pretty much where we were, right? So like a hamster on a wheel, we didn't really get anywhere after all that effort. You still want to watch it when the dollar starts to break and begins stretching its legs like that. It can have an effect on the rest of the market. So watch for simple structural levels, kind of take it out to the daily, mark out that 103, 101, maybe some weekly pivots. And as long as we're not breaking through those levels, then it should be all right. We start getting above that level or below the 101, then we can bring in the expectation that we're going to see some response out of the S&P. Ballpark, say the Dixie below 101, S&P should get above that 4,200. All right, dollar above 103 should see the S&P break that 4,000 level. It's kind of a generic structure, but it works, right? Something like that. All right, so for the 10-year, it faded off kind of nice. Still just maintaining inside that zone, and that's what we want to focus on. 3.36 on the downside, call it 3.6 on the upside. As long as we're inside that range, just like the dollar, as long as we're inside the range, everything is fine. It's going to be more about how fast is it moving at that point, and are we approaching the breakout zones? We had stocks and bonds falling together yesterday. It didn't stick. Obviously, if you look at how far we fell in bonds yesterday versus how far we fell in the S&P yesterday, they don't compare, right? We were down a lot more in bonds than we were in stock. But it was at this point yesterday where we had that move down in stock, quote, and we had the move down in bonds, right? So they do move together at times. We can't use them as an inverse correlated product, but generally, when one is going down, the other is likely to go up and vice versa. It's more about the why, though, right? All right, so looking at the two of these this morning, between the NASDAQ and the ES is already testing against that Globex low like it's ready to expand in a new leg down. The NASDAQ, on the other hand, set that Globex low yesterday evening, and we haven't really even come back to it yet. So we're about at the midpoint on the NASDAQ, which means we want to go look at the financials. I guess we're below the midpoint, right? We're below that 50% level. Technology is doing better than finance this morning. That's the takeaway here. We can see that since the NASDAQ is holding this rally up, that the ES has already sold through. Nat gas down, K-Web constituents. So your JD, BABA, Baidu, PDD, those are down. Emerging markets kind of gets thrown into the same thing. Biotech, which has been on a monster rip, is slightly down this morning. financials are down, but not as much as I had expected they would be. Bitcoin up, bonds up, gold up, dollar slightly up. So let's take it back and kind of, let's see. Kind of need to get a grip on where we're at with technology this morning, right? Because it's obviously doing better than the financials. So we can do something generic like XLK, or we can kind of build our own little ETF. Apple, Microsoft, Tesla, Google, Netflix, Amazon. That's a good start. So combined, they're up this morning. Certainly doing better than the financials, which are down. JP Morgan, Goldman Sachs, Wells Fargo, none of them are looking very good, right? And the same little trick that I did to show you a collection of monsters of tech, you can do the same thing with financials. So, you know, WFC, let's see, Bank of America, and JP Morgan. Kind of tuck those three together. Still not looking that good. Now, they don't have a lot of volume yet this morning. JP Morgan's got more than its peers. But there's your weakness. All right, so this is your weakness in the ES. If you're going to see that turn around, it's got to come from here. It's not going to be enough for tech to do all the work, especially since we're not really getting much help out of consumer discretionary with Tesla being such a dog. All right, so Tesla was looking pretty good earlier this morning, had a nice pop up right at the pre-market open, but it didn't stick, and it's already given it back and closed the gap. The fact that we closed the gap is more, to me, bullish than bearish. I know it seems inappropriate to say bullish when we're getting that sell-off like this, but the gap needed to be resolved. So now that the gap is resolved, whatever bullish nature caused this pop in the first place can now take hold again. Plus, you know, if we're looking for a resumption of this move from last Thursday, even with that little bit of sell-off, then we got to get outside of yesterday's range. Yeah, that is a head and shoulders inverted, but it's in the wrong place, right? It doesn't belong there. We would have wanted to see that head and shoulders inverted down here. You're not supposed to find it at the highs, right? It's a reversal signal, not a continuation signal. Same thing with that one. All right, so semiconductors are doing okay. Bitcoin is doing the best out of all of them. So Bitcoin proxies are going to be something worth focusing on. Riot, Mara, Coin, and even the ETF itself, BITO. If we have semiconductors and Bitcoin proxies, then we want to anticipate that we're going to get some China names. So we really want to watch those for a turnaround. And then a turn in financials to join tech names, and we'd have ourselves a rally and a breakout. If any of these start to collapse or really give it all back again, look for that short breakdown to continue. So keep your eye on KRE. Those are the financials. Once the market opens, you can watch NY Fang and KRE combined. Kind of give you that sense of what the market's going to do along these levels. And then just, you know, on the day, approach it from the idea that we're really not expecting to go anywhere. We can expand down a little bit, and we could rally back up to test, you know, and even expand beyond yesterday's high a little bit. But we're still going to have the expectation that we're going to hold the line into FOMC, which means the megaphone is going to be our number one focus, right? And the megaphone is the idea that you have a range and price pushes its boundaries just a little bit, and then it pushes its boundaries on the other side, and it pushes again, and it begins to create a little bit of a megaphone until finally price really breaks one direction or another, and the megaphone is broken. You can see, you know, an example of that back here for not the best example, but gets the point across. So take that concept and kind of make it bigger, since we're dealing with the whole week. And that'll be our expectation into FOMC, that we could, you know, expand a little higher and expand a little lower, and just kind of widen out things until finally we get FOMC and we break and do our thing. Everybody, be careful, be safe, have a good day. I'll see you all tomorrow.